Hello there and
Hi.
welcome to this special edition live stream here on CGTN, delving into the data of China's 2025 report card. It has hit that 5% target, and to talk more about it and to really dig deep into that data, we're joined by some very special expert guests today, but I'm also joined by my wonderful colleague Vivienne. We are CGTN Global Business Anchors, and here going into something of a more relaxed chat, I suppose, Viv.
Thank you, Link. Yeah, we're away from the TV studio and on the couch today. So I'm just going to bring in our live guests. So thank you so much to Zerlina Zeng. She's the head of Asia strategy at Credit Insights, and she's joining us from Singapore. We're also joined by Professor John Gong from the University of International Business and Economics here in Beijing. Thank you both for making time to join us for this live stream.
I always like to start with ladies first. Zerlina, can we start with you, please? Now, China's GDP hit that 5% target in 2025. How do you evaluate the quality of that growth, and which sectors in particular really drove that growth in 2025?
Thanks for having me here. I would say the 5% growth target, hitting that was within our expectation. I think start of the year, a lot of sell-side houses was a little bit pessimistic on China's growth, but we are more focusing on the coordinated policy implementations from monetary policy to fiscal policy. I think the momentum might have slowed slightly towards the second half of the year, particularly in the fourth quarter, if we look at some of the retail consumption data. But I think the market is still very much focusing on the bright spot, which is the exports number. Despite a lot of the global uncertainty, the exports continue to be one of the biggest highlight for China. And as a result, industrial production has been very strong. I think for now, the market is very much looking forward to the next year in terms of the policy implementation, as well as additional any incremental support will be of high interest to the market. I think in terms of the sectors, auto, especially electric vehicles, seems to be slowing a little bit. The market is paying attention to that. Towards the end of the year, there was the anti-evolution, this type of policies. Market is also paying special attention to that, particularly the effect on the PPI and CPI.
Thank you. And Professor Gong, I'll get your take on that. Where in the economy did you see as the strong points, and where were the biggest drags on the GDP figure in 2025?
Well, I think it's good to see that we are still on target for the 5% overall growth for the whole year. And I think China's economy is, even given, very decent growth number, I think the economy is showing signs of, evolving more of a sort of a developed economy where growth rate is quite modest if you look at the entire spectrum of developed countries. And I think probably more importantly, even though our aspect seems to be recovering, nevertheless, I think we're still living in the shadow of a slowing down of the real estate market. This is a fundamental structural change. China's economy is no longer relying on the fast growth of the real estate market. On the contrary, it's actually dragging the whole economy down. If you look at the real estate growth, it's in a negative double-digit territory. So obviously, China is looking for another engine of growth aside from the real estate market. And we're in the transitional period, essentially. The bright spot, of course, is the manufacturing sectors, especially in the high-end, high-tech, sophisticated manufacturing. China's technological prowess is still very much contributing to the growth of the economy, and partially also manifested in the strong export numbers. China's export sector is performing very well in 2025, logging a 6% growth. Chinese products are still very competitive. Keep in mind that 2025 is the year that we're facing an unprecedented wave of protectionism around the world, particularly from the United States. Nevertheless, China's export sector has been still performing spectacularly well compared to the rest of the world. Today, export sector is accounting for a little bit less than 20% of global trade. So, China's manufacturing is still showing a lot of strength, signs of strength and resilience. So moving forward, I think we are still going to be in a transitional period where the engine of growth is steadily moving away from the traditional sectors, particularly real estate market, into more of a innovation-driven, and high tech, high value added industries and sectors.
I want to pick up on that point with you, Professor John Gong, about that high-tech investment. I mean, how soon do you expect it can become a primary driver for growth, given that China is facing those challenges in terms of the real estate sector? There are calls for it to perhaps become less reliant on exports. We hear a lot of news, a lot of excitement around AI, about robotics, about these high-tech industries. How soon can it become a primary driver for the economy?
Yeah, well, this is actually a great question. Obviously, Chinese government is emphasizing heavily on investments in these sectors you just mentioned. And indeed, a lot of capital is pouring into this. The VC community is investing heavily in these areas. Nevertheless, if you look at the grand scheme of things, look at the percentage of these related industries as a percent of the entire GDP is still very small. So, the bulk of the economy is still very much about living, eating, and transportation, these traditional areas. So the question really is about whether, the innovation, the moving ahead in these sort of cutting edge industries will be able to play a locomotive role in pulling the rest of the economy ahead. And that's a tall order in my view, because the percentage of these sectors are still quite small compared to the overall size of the economy. And certainly, we like to see this transitional period to be accelerated so we can move quickly away from the old sort of, real estate centric development model. Nevertheless, that's a tall order. It's not easy. And it's going to take some time, I would say. So, I'm not going to paint a rosy picture about a quick transition. I think it's going to be a quite lengthy and to some extent maybe even painful transition. It's going to take some time. There's going to be structural changes in the market, in the labor market, for example. There will be folks who are having a tough time in adjusting to this new paradigm. But nevertheless, I think we are getting there. I think 4%, 5% growth is going to be the new normal, and we're going to live with that. As I said, China's economy is becoming more like a developed economy, where you have even 4% growth is regarded as a very high growth.
Thank you for that, Professor Gong. I'll just pick that up with Zerlina from Credit Insights. How do you see this period of transition that the professor was just talking about? I mean, he's saying he's not overly optimistic. It will be perhaps even a little painful. How do you see it?
I do agree with Professor. If we look at the real estate sector, 2 or 3 years ago, if you look at through the value chain, it is a really very heavy component of the Chinese economy. It also is impacting the government's financing. It's impacting the upstream and downstream industries. Our forecast is we are probably going to hovering around this down cycle for the next 2 to 3 years. It is going to be a slightly painful transition period, but I think from a policy point of view, this is also necessary because China indeed it does need to transit from the very fixed asset investment heavy economy towards more consumption, towards more high-end manufacturing driven by technology. So I think this is a necessary transitional period for this economy. When it comes to AI and technology, I think past few years the market has been very excited about it, but recently, particularly our analyst in the US is really pointing out this potential overbuild in the AI value chain, from your data center to utilities to even semiconductors. It's a very cyclical and capex heavy sector. So our analysts are paying more attention to this potential overbuild and the implication for not just the market, but also the general economy. So I think in some of the older traditional sector, China has experienced a certain level of overbuild. And to some extent, we're still in the stage of trying to addressing certain oversupply. So I think this is one risk factor that we need also to pay attention to.
On the policy side of things there, Zerlina, we've already seen at the start of this year some re-lending facilities and a reduction in rates, very, very targeted to start with the year. but there is room for perhaps fiscal stimulus and further monetary easing in terms of the reserve requirement ratio reductions, a base rate, interest rate cut at some point through the year. What are you looking for, and what do you think policymakers are looking for in terms of triggers to perhaps make that move at some point during 2026?
Yeah, I think what we are looking for is not headline number in terms how much fiscal stimulus, big stimulus come into the market, or even how many times the PBOC is going to cut or reduce the reserve requirement. What we are looking at is really this policy coordination and the transmission from monetary and fiscal policy into the real economy. I think if the PBOC continue to cut, there are certain sectors are going to face pressure in the economy, especially the banking sector. And we all know in the past few years, because of the real estate down cycle, some of the asset quality issues is emerging in the banking sector. If we continue cutting the rates, likely this is going to be a headwind for the banking sector. I think to some extent, the RMB is also correlated with where the interest rate is now in China versus the US and other development markets. Put it this way, the 30-year JGB yields are now higher actually than the 30-year Chinese government bond yield. I think the market signaling of the policies is also quite important. What we are looking for is, the result and implementation of these policies. On one hand, how this is going to support the high-end manufacturing, how this is going to support the consumption. Past couple of years, the consumer goods trading program has been quite successful, but over the past few months, this effect is fading out. And we are also looking at how the government will be addressing some of the credit issues within the system, such as local government debt issues, as well as the outstanding bad real estate related debt. So on one side is about stimulating the economy, transiting the economy. On the other side is also about the risk management.
I'll put a similar question to you, Professor Gong, bring you in on this one in terms of stimulus there. Zerlina mentioned the consumer trade-in scheme as well. What's your forecast for 2026 in terms of perhaps maintain stimulus or expanding these stimulus programs?
Well, if we're talking about central government stimulus package, I think we need to be moving away from the old paradigm of, using this money to stimulate investment in infrastructure side. I think we're clearly seeing a diminishing returns on this infrastructure investment. I think the imperative right now is to really bail out local governments. I mean, the issue is that the real estate slowing down is also having a profound impact on local governments' budget and their debt. And we all understand that, for some local governments, the debt has been, accumulating over the years, very much being sort of footed the bills by the real estate development. Nevertheless, this is totally slowing down. It's going away. And we all understand that the bulk part of China's economy, I think it's about 40%, maybe even more than 40%, is tied to central government and local government spending. So so the local government accounts for at least, I think, 20% GDP. So if they're slowing down, if they're tightening their belts, if they're cutting back, obviously it's going to have an impact on the rest of the economy. I mean, in many small towns and small cities, in local economies, a lot of people livelihood are tied to the government expenditures, and if they're not spending, if they're holding back, it's going to have a serious consequence for the local economy. I think this is the area where the central government stimulus package will have to go to. We have to accelerate this process to work out, this debt issue associated with local governments, the money they own to many companies, local companies, and help them come back to their normal budget. I think, over the long run, we don't have to be too much concerned about the size of a national debt. I think if you look at China's total accumulated debt as percentage of GDP, is still a very modest number compared to many other countries. So we have the room to maneuver here, and we have to do this very fast. So I think this is if we're really talking about central government stimulus package, will be my stronger recommendation. We need to accelerate this process. And not so much about, building more roads and more highways and railways. We already have a very good infrastructure. The money spent on these things will have diminishing returns.
Zerlina Zeng from Credit Sites, Head of Asia Strategy there. I wanted to pick up on something you just mentioned briefly, and that's the RMB. Now, we have heard calls from outside of China, particularly from the head of the IMF, Kristalina Georgieva, for China to allow the yuan to strengthen. How do you see that playing out? It would obviously have a huge impact on exports. China recorded a record trade surplus this year, despite those geopolitical headwinds and tariffs that we've seen. What do you think we'll see China do on that going forward?
I think the top priority for a PBOC or other FX regulator is really the stability of RMB. I think if the RMB appreciate too much, definitely this is going to be a headwind for a lot of the exporters. It's not great for the economy, especially the external environment is still very volatile. The US tariff still has a lot of uncertainty. So 1 week appreciation is definitely not what the regulator want. But we also don't want depreciation of the RMB. That's sending a quite strong signal that the macro economy is not doing great. It is also not good for a lot of the asset allocators because of the RMB depreciation. So I think stability and allowing RMB to fluctuate healthily within the band is a more ideal scenario for the PBOC and the regulator. But then to some extent, this is not only a regulatory decision, it's a market-driven currency fluctuation. When we speak with the investors in the global markets, last year, one of the hot topic was de-dollarization, about the weakening of the USD. This year, this theme is likely going to be an ongoing topic among investors. A lot of people are looking at diversifying their currency exposure in the fixed income space, talking about the very strong issuance of offshore RMB related bonds. So this trend will also continue. I think in general this year we are still looking at a slightly strengthening bias of a lot of Asian currencies, and RMB being one of the key anchor of Asian currencies. I think our view is a marginal appreciation pressure of the currency.
Professor Gong, is that your view too, a view towards stability over anything else?
Well, I may be a little bit more aggressive. I think RMB needs to be on the appreciation side. I think if you look at the offshore RMB market, and if you look at the foreign market, it's already appreciated greatly. I think it's more of a matter of the domestic RMB market being catching up with the offshore market. And contributing to more sort of the free capital flow between the two markets. Well, the benefit of that, of course, is that it alleviates a lot of the concerns for Chinese exports. I mean, there's an article, I remember, in Economist magazine saying that China is making trading possible. We are making things virtually everything, here in China. I think a little bit of RMB appreciation really helps with that. And probably more importantly, in my view, is that RMB, the expectation, at least the expectation of RMB appreciation would contribute to more capital inflow into China, which will lead to a run-up of the equity market. I think today, Chinese equity markets are still very attractive, even after a few months of a run-up in the past few months. Because of the stability here, the political stability, and the peaceful environment here in this country. So the better performance of the equity market will introduce a wealth effect for Chinese households, essentially, which will have a marginal propensity of consuming more, leading to more demand for goods in aggregate, better consumption numbers. So I think this is one way of probably achieving a couple of goals at the same time. And my view is that the market is already forming expectation that the RMB will appreciate more for the rest of the year. I think the question is really about, is it going to be 6.8% or 6.8 or 6.5 in terms of a dollar to RMB converting ratio. I am inclined to believe that RMB probably would appreciate to breaking the 6.8 mark.
Oh, for those of us earning RMB, that's wonderful news, and long may it continue. Thank you very much, Professor Gong. I'll stay with you, and I'd like to delve further into the service sector in particular. When we break down these GDP numbers, primary was up 3.9%, secondary, again, an appreciation, 4.5%, and tertiary, 5.4%. So that services sector is really leading the growth there. Breaking that down further from tourism, and I see IT was in IT and software, double-digit percentage growth, 11.1%. Those sectors are really, really leading it there. Are there any parts of the services sector that you think are dragging or lagging in there?
Rick, are you asking me?
Yes, Professor Gong, I'll stay with you for that one.
Yeah, okay, yeah. Well, I think, as I said earlier, one of my themes for today's conversation is about China's economy becoming more and more like a developed economy. And one of the defining hallmark of a developed economy is the increasing percentage of the service sector in the GDP. As a matter of fact, this is indeed the case. We are seeing ever increasing percentage of the service sector in the GDP. And across the board, you look at the growth in service sectors, we're seeing better growth numbers than in the manufacturing sectors. And of course, compared to the real estate market. When we talk about consumption, enhancing consumption, in my view, the growth areas are not so much lying with the traditional sort of, going to the mall, buying things, or have better foods, increasing budgets on food and other things. I think it's more about sort of experience related consumption. And especially I think for the emerging new modes of consumption related to technology, related to new frontiers of consumption. Let's be very honest here. These consumption areas are mostly associated with the middle class and above middle class people. People are relatively wealthy. This is where the consumption is going to come from if we're really talking about enhancing consumption here. So I think in order to encourage these people to spend more, certainly I just mentioned the wealth effect associated with the equity market. In addition to this, I think we need to have a much more stable and accommodating and relaxed political environment here, so that the rich people feel safe to spend, and they're willing to spend, instead of accumulating money trying to send it to somewhere like Singapore. I think this is actually very important that we have an environment where the relatively wealthy people feel safe and feel there's more opportunities in the domestic market. So I think this is one area we really need to work on, especially in terms of protecting private entrepreneurs, private companies. I think one thing I can point to is that recently we have this incident between one internet influencer essentially staging a war against a private company on the internet, which is a restaurant franchise company. This is not healthy. I think we need to do something about it to make sure that the entrepreneurs, the private business people feel protected, and they are very comfortable with spending more and investing more.
Ms. Zeng, can I bring you in on the services sector question? Obviously some very, very strong growth. It's leading that growth in consumption there. Is your view on 2026 and beyond just as bullish?
I think we are still quite bullish on services, but at the same time, we are actually more bullish on the manufacturing. I think from an economic development point of view, the manufacturing sector is still the backbone of the economy. It ensures that the economy is resilient and counter-cyclical. It also builds the international position and resilience of the Chinese economy. When it moves to the services sector, across the different companies that we cover, we do see this trend of consumption downgrade. To some extent, it helps some of the sectors, some e-commerce platforms, some of the live streaming companies, smaller tickets, domestic tourism, and the food and beverage services. This trend will likely continue in 2026, given the property sector still have lingering impact on the economy. But I think some of the new areas of consumption that Professor Gong just mentioned, such as technology-related ones, AI PC, AI smartphones, these ones could be the bright spot for 2026. The other interesting thing is in the past, people are seeing buying a house as a main channel of preserving their wealth. But these days, because the home prices is still having a downward trajectory, a lot of people are thinking about maybe they will spend more, maybe they will do more financial market investment. To some extent, I think this is healthy for the economy rather than having the money locked up in one sector, one single sector. It's channeling it to the financial market, channeling to funding the real economy, and channeling to the consumption sector.
One area we haven't touched on yet is employment and the labour market, and there is still some weakness, particularly among youth unemployment. Now, we also know there are some areas that we mentioned earlier that are kind of driving or moving towards driving the economy. I'm thinking about sectors such as AI and robotics or high-end technology. Those industries say they're crying out for staff. A lot of recruiters say there's a lot of vacancies there. How does China manage that kind of mismatch in the labour market and where those jobs are needed? Professor Gong, I'll start with you.
Yeah, well, I think probably we are underestimating, how technology is transforming the labor market. I think it's a fact that Chinese companies are more and more utilizing technologies that are essentially replacing people. I think it used to be happening in the manufacturing sectors. Well, let me first say that manufacturing sectors are particularly susceptible to this kind of machine replacing people phenomena. And it's not just happening there. I think it's still starting to percolate down to software companies, more high-tech companies. They are even laying off people, programming people, and employing new technologies. This is a good thing. It's also a bad thing. And the bad thing, of course, is that people are being replaced. The good thing is that it means Chinese companies are embracing technologies and contributing to better productivity gains. Looking back in history, we economists, we train as economists, always have this view that every time there's a wave of technological revolution, history never fails us to create more jobs than the jobs being replaced. Every time pundits were predicting that this time is different, more jobs will be lost. The statistics are shouting back at us and saying it's not the case. And I'm actually still very confident that AI is no exception. We are going to see the days of more jobs being created than the jobs being replaced. Nevertheless, again, we are in a transitional period. This structural adjustment in the labor market has a time lag to it. So this transition is going to take some time. And it's also, again, it's going to be quite painful. There will be people who are going to lose their jobs, and they have to be thinking about something else. So the problem is that people, close to 50 years old, 40-some years old, it's very difficult for them to reorient to a new career. It's very difficult. This is the sad truth here. I think we economists can sit back and look at these statistics, sort of these cold statistics, with a sort of academically correct view. Nevertheless, we're talking about families here, right? People who are in their 50s losing jobs and trying to keep food on the table for the entire family. It's going to be very painful. Nevertheless, I think still in China, we have a very strong family financially backup network. And this is also in one area where governments can step in to help these people. President Xi, has a very strong people-centered agenda. We have just made the claim that we have achieved a great goal in terms of poverty alleviation. So we need to help these people. In short, I think over the long run, I'm not so much worried about it. But in the short run, we're indeed seeing these very painful statistics that people are losing jobs and people are having a tough time finding jobs.
And Zerlina, Zeng, watching this from Singapore, I mean, China is by no means the only country grappling with a labour market in transition, but perhaps because it's moved so far towards advanced manufacturing, perhaps it's feeling that pain first. How do you read the situation?
I would say China's labor market is still very resilient if you compare it with the developed market. If you look at the US, the non-farm payroll numbers has been negative past 3 months, and on those rolling average has been in the red for quite a while. The other important thing is in the US, the labor participation rate is coming down. The labor force is basically shrinking. But in the China, we do still have a lot of graduates coming out from the college. The labor force is growing. The woman participation rate is very high. So overall, if you look at the picture, I think China is relatively in a healthy and stable condition for the labor market, while in the US, to some extent, a lot of European markets, the situation is deteriorating. When it comes to AI, actually, I think the near term, this might be good for the labor market because the hyperscalers, a lot of Chinese technology companies, as Vivienne just mentioned, they're hiring, they're spending a lot of capex, building up their AI capacity, they're spending on their softwares, hardwares, and in able to realize a lot of their capex plans and their AI initiatives, they need to hire people, not just the coders, but also in the manufacturing sector, people who are supplying the raw materials to the semiconductors manufacturing. So I think over the near term, this is actually a plus for the labor market. The impact on productivity gains and the impact on unemployment over the medium to long term, I think this is very difficult to predict. For sure, some sectors will be losers and some sectors will be gainers. This is really dependent on the government policy. How do you retrain your workforce? How do you reallocate and optimize your workforce? I think it's a big task going forward.
Thank you very much to our special guest. Unfortunately, that's all the time we have for this special edition CGTN live stream, delving into the data of GDP in all the manufacturing sectors and services sectors, and a lot of different divergence in the data, but it's been really, really impressive to get the expert opinions. So thank you very much, Zerlina Zeng there from Credit Sites, joining us from Singapore, and Professor Gong as well. Always appreciate you guys coming on and joining us for these sorts of things. So thank you very much.
Yeah, thank you, Ling.
Thank you.
Thank you very much, guys. Hopefully you can join us again for another live stream. We'll have something coming up for you throughout 2026, I'm very, very sure.